Continued weakness as well as far as oil goes. The interesting thing is that the OPEC demand and product is currently there. So the demand is there, but as I said, the supply factors are the main factors that are driving this at the moment. So with the current market in balance, we believe that as we push forward to the end of this year, those prices will be able to be sustained at this current level. I like this slide because it's interesting, because a lot of people believe that at the end of the day the world oil supplies are running out. The interesting thing that we're currently seeing here at the moment is that there is oil, but the interesting thing is that we're not seeing investment in oil to find oil. So if you find on the slide, there's actually a significant decrease in actual expenditure at the moment, looking for opportunities to actually try to find some more oil at this point. Currently those levels are going to be in the same level as far as spending goes, but we believe that potentially in 2011 with the rebound of the economy, that's quite possible that that increase in spending will incur for the research. Going back to the agricultural scores, the interesting that we're finding on the agricultural side, that we believe that there is a fundamental demand underlying all agricultural products. There's an increasing need to feed people, cattle, and obviously cars. In addition, there is a decreased land space and water constraints underlying the bullish trends of the agricultural sector. As a result, we believe any significant price weakness in certain markets, and I'll draw your attention to wheat and corn that we saw, is purely temporarily, and in fact a surge in some agricultural prices this year demonstrated that even with a small drop in supply, we can react violently to the upside in price volatility. Corn, unlike energy and metal complex, have seen significant increases in inventory in agricultural complex. Continued increased demand is significant, and as a result we'll see prices in corn to be underpinned going into 2011. The interesting thing is it's obviously affected by seasonal factors. The summer months have historically been the most hazardous time for the year for corn returns. We find that 60% of the time corn returns have declined in June, July and September, and as a result we're looking for an increase in prices over the next 3 months period. With actual demand in ethanol, ethanol is on the rise. At the moment, currently, it was only 5% of the US budget as far as moving for what they had for fuel. We believe that at the end of the day, that's going to rise substantially to around 32%, of which probably peaking at around 2012. That means that almost 40% of all fuel will come from alternative fuel sources, and as a result, we'll see opportunities within the ethanol fuel area, so that corn and other factors will be able to support it in the prices. China's obviously trade position in agriculture is obviously a major global driving factor. Currently China becomes increasingly reliant on agricultural inputs. The country may already build strategic reserves in a number of agricultural commodities such as soybeans and rice. Urbanisation and rising living standards are expected to intensify, and as a result agricultural shortages will see an underpinning of the fundamentals in prices. Again, Chinese demand for copper has been increased in 2009. We see that to continue in 2010. The strong rebound of the Chinese economy has led to a surge in copper imports as traders and consumers have built inventories in anticipation of a surge in demand. So supplies in China have increased, while not necessarily the US, and looking for the opportunity. So this demand is obviously going to continue and underpin these current sectors. There is a significant amount of new regulations going on in the agricultural sector. A lot of it's got to do with the CFTC in the States, looking for opportunities to support and cut down on the level of speculation. This is going to significantly change the way that potentially people trade these underlying products going forward into next year. There is a couple of significant standouts. There are possibility between the price distortions between futures and physical underlying markets. There's also the possibility of increased market volatility and an incentive for people to actually hold on to their physical inventories. Also, there's opportunities potentially where premium of commodities that are easily stored and physically with low storage costs, where there will be significant increase of demand for storage facilities as people like to back the ETFs that are currently looking to be launched coming into the new year. Banks also are significantly moving away from trading futures as far as on the commodity sector, and they're looking towards moving into the physically backed trading sectors. Banks are also looking to design customised OTC derivatives for commodities. However, the opportunity of OTC derivatives looks like they'll be centrally cleared through a central clearer. Storage and warehouse companies will significantly benefit from this type of increase of holdings of commodity price. In addition, the last thing is that there's a significant push where we'll have opportunities for people to move into probably less regulated markets, where Dubai, Hong Kong and Shanghai, for example, will benefit from the opportunities of trading commodities in this sector. So just to revise where we are at the moment before I finish up. So we believe at the end of the day on energy prices, we believe that the rally in commodities has further to go in 2010. The prospects of fresh US dollar lows will support this. However, further rally in oil prices is reluctant and difficult to sustain going into 2010. We believe industrial metals will continue to be the best performer, and this will be mainly driven by China domestic demands and a fragile increase in global GDP. Precious metals will be driven by US dollar weaknesses, which will continue to see sustainable demand and support, and as the net buyers of central banks will be supportive, as they've been the first time they've been a net buyer since 1988. Structural factors in the agricultural sector will see a drive in agricultural prices, an increased need to feed people, cattle, cars, and environmental factors will see support of these prices going forward. Anyway, thank you very much, and I'll look forward, I'll have an opportunity to send through on my program. Thank you.